The FedLife podcast is presented by Serving Those Who Serve, a fiduciary, fee-based financial planning firm serving federal government employees and retirees all over the country. This podcast is for informational purposes only and is not intended to be taken as financial advice. All listeners should consult their personal advisors before taking any action. The opinions expressed by our hosts are their own and do not reflect the views, policies, or position of Raymond James. Securities are offered through Raymond James Financial Services, Inc., member FINRA SIPC. Investment advisory services are offered through Raymond James Financial Services Advisors, Inc. Serving Those Who Serve is not a registered broker-dealer and is independent of Raymond James Financial Services, Inc. And now, here are your hosts. Dan Sipe serves as a branch manager for Raymond James Financial Services and Serving Those Who Serve. Ed Zerndorfer is our guest and federal benefits expert in the space.
Hello and welcome to this episode of the FedLife podcast. If you're new, I'll introduce myself. I'm your host, Dan Sipe. Additionally, I'm the branch manager here at Serving Those Who Serve and Lee Sipe and Associates. And I'm going to begin, as I always do, by saying thank you. Thank you for taking the time to join us today to watch or listen, but also, above all, thank you for your service to the government, to the country, to me, to everyone. You don't hear it enough in normal times. These are not normal times. So you're definitely not hearing it enough now. So we are very grateful to you and all you do. Ed Zerndorfer, back with us once again for this. The guru is here as part of our ongoing mission to reach, teach, and serve you. Once again, we're going to follow Ed's FedZone articles. That gives us one more way to amplify and reach and teach, or as I like to say, your notes are already taken. So if you're watching this and you're trying to scribble, don't worry about it. You can just go back to the article. And we're tackling a really timely topic, which is Roth conversions. And they are going to be really big topics coming to the new year. But with the passage of the One Big Beautiful Bill Act of 2025, we now have a permanent extension to the Tax Cuts and Jobs Act. So the question Ad is asking in his article is, do Roth conversions still make sense for federal employees and retirees? This is critical year-end tax planning stuff. So drum roll, Ed. Let's start with the big picture. With tax rates now permanently extended at these lower levels, does that change the calculus on Roth IRA conversions, in your opinion?
In the answer to your question, Dan, it does, because let's talk about what happened earlier this year. With the passage, before the passage of the One Big Beautiful Bill Act. The current low individual tax rates are a result of the passage of the Tax Cuts and Jobs Act of 2017. So effective January 1st, 2018, individual tax rates were lowered to the lowest they've been in 100 years. The individual federal income tax was started back in 1916, and the rates, as a result of the passage of TCJA for short, were never this low. And it invited a planning opportunity, particularly for highly compensated employees, employees who have large salaries, got a lot of income.
Sure.
So that if they had an opportunity to pay taxes, they have to pay taxes now rather than later. For example, when it comes to IRAs, you have choices of different types of IRAs. You have a traditional IRA, contribution goes in, you make a contribution. If it's a deductible traditional IRA, the contribution you make is an adjustment to your income. It'll lower current year taxes. But you pay taxes with a traditional IRA when you take the traditional IRA out after 59.5. So it's always been recognized that it makes sense to contribute to a deductible traditional IRA if you expect to be in a higher overall marginal tax bracket, if you are going to be in a higher overall marginal tax bracket when you contribute to it versus when you take the money out. So with the passage of TCJA, lower tax rates, it didn't really make sense to make a deductible traditional IRA contribution, knowing that probably later on you're going to pay more in taxes because tax rates will be higher. But with the passage of TCJA, it's just the opposite. Rates are lower now. It will probably go up. That being said, it invited for an opportunity to, if you had a traditional IRA, you already contributed to one in previous years, because traditional IRAs have been around since 1974. And you always have this opportunity to convert a traditional IRA to a Roth IRA. That's the other type of Roth IRA. With the Roth IRA, there's no tax benefit for contributing to it, but the tax benefit of a Roth IRA is that when you take the money out of a Roth IRA after 59.5, it's tax-free. So if in fact you expect to be in a higher overall tax bracket when you take the money out of this IRA, then it makes sense to contribute to a Roth IRA while rates are low, but rates are going to go up. You won't have to worry about paying higher taxes. At the same time, it makes sense that if you have an opportunity to convert a traditional IRA to a Roth IRA, now with low tax rates, it makes sense. So effective with the passage of TCJA, individuals, particularly those who were not allowed to contribute to a Roth IRA. What do you mean you're not allowed to contribute to Roth IRA? One of the downsides of a Roth IRA is the fact that if your adjusted gross income is too high, then you're not allowed to contribute to a Roth IRA. It makes no difference if you have a pension plan, makes no difference. Let me give you an example for 2025, because I want to just mention that individuals still have an opportunity to make a 2025 Roth IRA contribution. They have until April 15, 2016. So here's what it comes down to. That if you file as a single person, single or head of household, and it turns out this year for 2025, your adjusted gross income is over $150,000, You're not allowed to contribute to a Roth IRA because your income's too high. If you file as married filing jointly, and you and your spouse's adjusted gross income in 2025 is over 236. Actually, I made a slight error here. For a single person, it starts phasing out. Your ability to contribute to a Roth IRA starts phasing out based on starting AGI of 150,000. Over 165,000. That's when you could not contribute to Roth IRA. And if you file as married filing jointly, and your adjusted gross income is over $246,000, neither you nor your spouse can contribute to a Roth IRA. You cannot make a direct contribution. But these individuals, whether you're single, married filing jointly, even married filing separately, no matter what your income is, you always are allowed to convert a traditional IRA to a Roth IRA. You can always do that. But here's the problem. You got to pay the taxes. You got to pay the taxes doing the conversion. And I just want to mention that I get lots of questions all the time from clients. I have as you know, accounting and tax practice. And particularly this month in December, in the year, I have clients who are saying to me, they're stockbrokers, they're financial planners, they're insurance agents who are pushing them. You should get this Roth IRA. Do this Roth IRA. You can't make a contribution. Why don't you think about converting it? Converting rate. The person says, why should I do that? Well, tax rates are low now. The tax rates are low. Well, this does make sense in some cases, but I will tell you, it especially makes sense if you expect to be in a higher overall tax bracket when you start taking money out of this IRA. Another advantage of a Roth IRA has always been the fact that a Roth IRA, unlike a traditional IRA, has no RMD, no required minimum distribution. And boy, people thinking about, gee, I heard about this RMD. You mean to tell me I have to take money out of my traditional IRA when I reach some age? I call it a required beginning date. I think it's age 73. It used to be 70.5. Congress raised it to 72. It's 73. It's going to go to 75 in about 5 years. The fact of the matter is, ladies and Dan, is that these RMDs, I don't know. Yeah, when you talk to your clients, they don't like those. They don't like this. God, the government's forcing me to take my money out. I said, the government's not forcing you to do anything, but they say, listen, we've given you this tax deferred ride all along here in terms of your IRA. We haven't paid 1 penny of tax. But now there's a limit. You got to start taking the money out and pay tax. And then they say, you mean I got to pay tax? It's going to include my income? Oh my God, I may have to pay more taxes then. I may have to pay more for Medicare Part B. I heard that my Medicare Part B premium is based on my adjusted gross income. Boy, this is not good. Is there anything I can do to minimize that tax bite and to minimize what I'll have to pay in the future for Medicare Part B? Yeah. The answer is Roth IRAs, because it will not be including your income.
Gotcha.
All right. So the Tax Cuts and Jobs Act of 2017 did many people a favor by lowering tax rates. The problem with the Tax Cuts and Jobs Act of 2017, it was due to expire on December 31st, 2025. So before the passage of OBBA, there was still a lingering doubt, I know in my mind, what's going to happen? What should I advise clients in terms of converting traditional IRAs to Roth IRAs? Should I still recommend they do that? Well, the answer to my question was answered with the passage of the OBBA. And that is, Congress renewed these low individual tax rates, the highest going anywhere from 10% all the way up to 37%, depending on your taxable income. I think, Dan, you said permanently. I think it'll be for at least 5 to 10 years.
Yeah. Permanent is relative.
Yeah, I think so. So this invites for continual opportunity to convert traditional IRAs to Roth IRAs, taking advantage of these low rates. Because it's my feeling, and I've never been in the prediction business. I don't predict things, but it's my gut feeling, Dan, with our ballooning deficit in this country, tax rates have to eventually go up. I'm sorry. They have to go up. The Congress is going to have no choice. So it's not a matter of if, it's a matter of when. And that when will probably be at a time that many of our listeners and people who, I know that I work with and your clients, Dan, they will have to take money out of those traditional IRAs, and they're going to have to pay tax. And chances are they will pay at a higher rate because interest rates will go up. So now it makes sense to do these conversions of traditional IRAs to Roth IRAs while we have these low rates.
No, that makes sense. So Ed, you kind of go under the hood now with the article, and you talk about some of the issues that need to be considered. First one is that if you do a Roth conversion, you're going to increase adjusted gross income. So walk us through why that matters.
Yes. Let me just say something, one thing up front. These conversions of traditional IRAs are not to Roth IRAs, are not for everyone. They're not appropriate. They're not appropriate for everyone. And that's why I brought up some of these issues. And one of the issues is that when you convert a traditional IRA to a Roth IRA, the amount that you're converting, all that pre-tax money, which includes deductible IRA contributions, accrued earnings, Dan, you are going to have to include the amount that you're converting in your current year income. We're talking about right now, we're in December. We're almost at the end of the 2025 tax year. If you perform that conversion, you convert that conversion, and this month is going to be included with your other income. It'll raise your AGI, your adjusted gross income, which means you're going to probably have to pay more in taxes. It could result as a result of raising your AGI. It may result in the loss of some tax credits. some tax deductions because many of the federal tax credits, and then Dan, I love credits. I love them. Because they're a dollar
Yes, you
to
do.
dollar reduction. You could lose them because they are a function of your AGI. If your AGI is too high, you could lose eligibility to take advantage of those credits. And same thing with deductions. So that's something individuals have to be aware of when it comes to conversions.
Sure. Gotcha. And you also indicate that feds should moderate the amount that they're going to convert so they stay within their current tax bracket.
Yes. Anybody considering a traditional IRA conversion, you have to decide how much you want to convert. There's really no minimum amount. Well, the maximum would be the amount that you have in traditional IRAs. But as I said a few moments ago, the more you convert, the more is going to be included in your income. And my rule is, and this is what I tell my clients, you should only convert in a given year the amount of your traditional IRA, the amount of in your traditional IRA that will keep you in the same marginal tax bracket. Now, what are the marginal tax brackets? I'm not going to go down to the low ones, 10, 12%. I'm going to start with the ones that most feds
Sure.
are in. 22%, 24%, 32%, 35%, 37%. It's the highest bracket. So depending on your filing status, single, married filing jointly, head of household, married filing separately, before you consider how much of your traditional IRA you want to convert, do an evaluation. See where you stand as of the day that you want to convert that portion of that traditional IRA. How much taxable income do you have? Add it all up. What is going to be your taxable income to date? Now you take a little work, and that includes your salary, your taxable salary, any investment income, interest, dividends, capital gains. You might have, might be getting Social Security. Maybe if you're a retiree, getting a federal retiree service annuity, FERS annuity, traditional TSP, good distributions. See basically where you stand when it comes to your taxable income, not adjusted goes in, taxable income, because that will determine what bracket you're in. And when you come up with that amount of taxable income, and that will determine what your marginal tax bracket is, figure out how much will you need, can you convert to keep you within the same bracket. And I think the best way to understand is to go through an example. In my column, I have an example, which I'd like to share. And here's the example. Carla is a single federal employee. She's age 52 years old. She currently has $352,500 in a traditional IRA and is considering converting a portion of that traditional IRA to a Roth IRA. Now, she must have listened to me because she talked to her tax advisor before she did anything. And that's what I always say. Don't do this on your own. If you're doing this, if you are considering this conversions, please talk to a tax advisor. If you don't have one, get one. It's worth it. You don't want to do this on your own because you could end up hurting yourself. All right. She's advised by her tax advisor to convert only the portion of that traditional IRA that will not result in Carla being pushed into a higher federal marginal tax bracket. Now, during 2024, Carla was on a 24% marginal tax bracket, and she expects her taxable income during 2025, this is before she converts that portion of her traditional IRA to a Roth IRA. So what did Carla do? She went to her tax advisor. Her tax advisor looked up in the IRS tables. IRS has tables for this, Dan. It's called marginal tax bracket, given filing status, given the amount of taxable income. So according to the 2025 federal tax bracket threshold table, Carla could convert approximately $36,000 of her traditional IRA to a Roth IRA and remain in the 24% marginal tax bracket. Now, how much would she have to pay in federal tax? Well, she's in the 24% tax bracket. It would be 24% of 36,000. Now, let's suppose Carla doesn't listen to her tax advisors. I want to convert 50,000. Well, the way it works is the first 36,000 will be taxed at 24%, and then the other 14,000 will be taxed at the next bracket, which is 32%. She's paying 8% more in tax when she doesn't have to. That's what I mean, working with the taxes. Stay within your bracket.
Gotcha. And this nice segue, because this goes into your second issue, because there's another bracket out there that people forget about, and that is to do with Medicare.
Yeah.
So speak to that a little bit.
Yeah. When a federal retiree enrolls in Medicare Part A, which is the hospital insurance, there's no monthly premium for that. But when they enroll in Medicare Part B, some employees go into Medicare Part D. Medicare Part B, the amount of premium that you pay is based on, they call it the modified adjusted gross income. For most feds, modified adjusted gross income is the same thing as their adjusted gross income. So, and the same thing is true for Medicare Part D. Now, the difference here is that we're talking about a 2-year lag. So, if we have an individual who is converting their traditional IRA to Roth IRAs this month in December, let's say December, and it's going to add to their AGI, that's going to have an effect. It could have an effect on the amount that they pay for Medicare Part D and Medicare Part D for the year 2027. Because the Medicare Part B and Medicare Part D monthly premiums are based on 2025 AGI. Why won't they use, let's say, the current year, 2026? And here it is, they're getting a notice in 2026 because you haven't filed your 2026 tax return. They got to use the most recently filed tax returns. I know this year I got a notice for my Medicare Part B premium, my wife. We got it last month. For what we're paying for 2026, it was based on our 2024 AGI. But here's the point, that what you pay for Medicare Part B and Medicare Part D is based on these AGI, they call them income tiers. And if you are in what's called the first income tier, you don't have to pay anything additional to that basic monthly premium. For 2026, that the first income tier, the monthly premium is $202.90.
Gotcha.
If you're above that and you go up a certain amount, you get into the second income tier, you're going to pay an additional $81.20 per month in addition to the 202. These are called IRMAs, income-related monthly adjustments amount. I call it Aunt Irma. Irma's not very nice.
Yeah, she doesn't bring good presents.
But the point is that you can control those IRMAs by controlling your AGI. And one of the factors is going to be used in your AGI. I mean, what's going to be include your income? Sometimes, you're obviously getting, when you get retirement income, CS arrest, no deferrals, no getting Social Security, you can't control that. You're going to get that and you need it. But when it comes to traditional TSP, you can control how much you're taking out of traditional TSP. You can control how much you're taking out of your traditional IRAs. Although when you reach that required beginning date, you have to take money out. But Roth IRAs, Roth TSP is not going to be including your AGI. So that is another point of doing these conversions of traditional IRAs to Roth IRAs long before you become Medicare eligible, because this way you won't have to worry about having to pay more for Medicare Part B and Part D, because it's not going to be included in your AGI. If you take the money out, it's not including your income.
Gotcha. And your third issue is a sneaky one. And I know this catches a lot of people out there. And that has to do with estimated tax payments. So, for example, if somebody pops up with the idea, oh, I'll do one in December, they could get a real surprise there. So talk to that a little bit.
Yeah, Dan, tell you, I hate to give my clients bad news when it comes to taxes. And one of the biggest, gee, I didn't know that. It really bothers me about that. And what is that? I didn't know that. You owe a lot of money. You owe more than $1,000 to the IRS when come file your taxes. And it says it bothers you to owe that you owe more than $1,000. Yeah, it's not a good idea. But here I'm going to give you some bad news. You could be subject to an under withholding penalty. You didn't pay in enough. I mean, how so? Well, I had money withheld from my paycheck. Yeah, but you had other income that was not subject to withholding. One of which is when you convert a traditional IRA to a Roth IRA, the IRA custodian is not going to withhold any federal and state income taxes. And the person says to me, why not? Shouldn't they? After all, when I take money out of my traditional IRA, they ask me, how much do you want to have in federal and state income taxes withheld? They ask me that, and I tell them, why shouldn't they withhold taxes from when I ask for a conversion of my traditional IRA to a Roth IRA? Now, what do you think the answer is, Dan? Have you ever gotten that question from a client who wanted to convert?
Sure.
And what's your answer?
Well, what's your answer, Ed? Because I'm always going to follow you, brother.
Oh, the client doesn't like my answer. My answer is, your IRA custodian is doing you a big favor. So what do you mean doing me a big favor? Here I owe this ton of money as a result of this conversion, my traditional IRA. I got all these taxes. And you're saying to me that the custodian that is doing me a favor by avoiding taxes? I said, yeah. And here's an example. Suppose you converted a $100,000 traditional IRA to a Roth IRA. And you owe, 24% federal income tax on that conversion. And you said to the IRA custodian, I insist that you withhold $24,000 in federal tax. The IRA custodian is going to say, no, I'm not. I'm going to do you a bit. I'm going to do you a bit. I'm not going to do you a favor. I'm doing you a total disfavor. I'm not doing you any. I'm not doing. This is not in your best interest. So first of all, why not? Because if I withhold $24,000 in federal income tax, Dan, how much is going to end up being converted to a Roth IRA?
Out of 100,000, that's going to be
76,000.
Yeah,
because the 24,000 was put into for federal taxes. They lost 24,000 in the conversion. That's not good. So the bottom line is, you are responsible for paying the taxes due on that conversion. In this case, how much, Dan? 24,000. Suppose they live in a state that has an 8% state income tax. Another 8%. 8,000. So the person has to make what's called an estimated tax payment. I'd had this situation. I had one client, and it was no longer my client because she got tired of the bad news I gave her all the time. She had an IRA with a major brokerage, not going to mention the name, but she had a broker who called her like on December 22nd and said to her, that IRA, that traditional IRA that you brought over to the firm has really gone down in value. It was worth like about $150,000 when you brought it over. unfortunately, the market's going down. It's now worth probably about $110,000. You lost $40,000. Gee, this would be great. This would be great. A great candidate to convert to a Roth IRA. Now she got this call on December 22nd. So she said, I got to think about this. I got to think about this. So broker said, okay. So about a week later, December 29th, he calls back. What did he decide? Well, I'm still not sure. He said, let me emphasize again. This is the best time of year to do this conversion. The best time of year to do it. Okay? So she says, all right, let's do it. So he did it. So she called back the next day. She said, oh, yeah. He says, what about the taxes? Well, the taxes are, she owes about, it came out to be something like $21,000 in federal taxes for that conversion. She says, $21,000? I don't have that kind of money around. She said, well, don't worry about it. The broker said to her, you can pay the balance due when you file your taxes in April.
Oops.
Oops. I'm glad you said oops to me.
Oops.
First of all, I used to have a securities license. I no longer have it. But one of the rules is a stockbroker, a financial planner is not allowed to give out tax advice. That's why God created tax professionals. Okay? What the broker should have said is, number one, talk to your accountant. Okay? Because your accountant would have said to you, no, you cannot wait till April 15th. You got to make an estimated tax payment, which is due January 15th. That's what have to do. When you do a Roth IRA, to a traditional IRA conversion to a Roth IRA, you owe tax. You owe tax, federal, if you live in a state, tax. And you are responsible for paying that tax due via an estimated tax payment. There are 4 estimated tax payments due each year. They're due on April 15th, June 15th, September 15th, and the following January 15th. If you perform a traditional IRA conversion in the first quarter of the year, between January 1st and March 31st, what is your estimated tax payment due? April 15th. The April 15th right after following the March 31st. If you perform a Roth a conversion in May or April and May, what is your estimated tax payment due? June 15th. Make the conversion June, July, August during one of those months. September 15th is your estimated tax payment, both federal and state. And finally, September, October, November, December, January 15th. If you don't make that estimated tax payment, you're going to be subject to an under withholding penalty. And those under withholding penalties are nasty. It's unnecessary.
Gotcha.
You do not have to pay that penalty if you do the things correctly and work with a tax professional. So
Absolutely.
I caution anybody thinking about doing these traditional IRA conversions, don't do this on your own. Work with a knowledgeable tax advisor. Now, the issue about whether it makes sense, maybe in terms of more opportunities, in terms of investments, things like that, and Roth IRAs, that's something you'll have to talk to a financial advisor who's licensed to do that.
Gotcha. Okay. And I'm going to jump around a little bit here because we're starting to get pretty close on time, and there's a couple that I want to make sure we give enough time. So, folks, I will encourage you definitely to read Ed's article. So I'm actually going to jump to your 5th point, where Roth conversions might not make sense at all. So you mentioned the 5-year rule and some other scenarios. Tell us about those.
Yeah. Okay. First of all, point I want to make about when a Roth IRA conversion doesn't make sense is, and goes back to what I said originally earlier. If at the time you expect to be in the same or in a lower overall marginal tax bracket will you withdraw money from your IRA as your overall marginal tax bracket when you contributed to it? Generally speaking, a Roth IRA does not make sense from a tax standpoint. That's number one. Here's something that many people are not aware of. That who's going to be your IRA beneficiaries? Your IRA beneficiaries. Because if you've decided that your IRA beneficiaries are going to be a charity, an organization, and believe me, that they'd be more than happy to get your IRA money because why? When you bequest your traditional IRA to the charity and the charity cashes it in, charities don't pay taxes.
Yep.
So it doesn't make sense for you to take your traditional IRA, you pay the taxes because you're converting to Roth IRA, and then bequest the Roth IRA to the charity. Because if the charity cashes out the Roth IRA, it's going to be tax-free anyhow. That's another possibility. And the third possibility is if your IRA beneficiaries will be in a lower overall marginal tax bracket by the time they inherit your IRA. It doesn't make sense. But keep in mind that a noun spouse inherits your IRA, like a child, adult child, maybe a sibling, and maybe their income will be very limited, perhaps down the line. It doesn't make sense for you to convert the traditional IRA to a Roth IRA, pay the taxes, when in fact, when they inherit your traditional IRA, they'll pay much less taxes than you would if you were converted. So those are a couple of possibilities.
Gotcha. And number 6 is actually a preview of coming attractions, because I know you have had your pencils out and sharp and your pads, so you've been jumping on this as the information flows out to you. Starting January 1st, 2026, there's going to be the option for in-plan TSP conversions from traditional to Roth TSP. So tell us a little bit about that.
Yes, Dan, it's finally here. One of the provisions coming out of Secure Act 2.0, which was passed in 2022, is starting January 1st, 2026. Qualified retirement plans, which include 401k plans, 403b plans, 457 plans. The TSP, although it's not technically a qualified retirement plan, it shares many of the features of qualified retirement plans. But the point is that these plans will be allowed starting January 1st, 2026 to allow their traditional account owners, traditional 401k, traditional 403b, traditional 457, and traditional TSP participants will be allowed to convert portions of their traditional TSP to the Roth, in this case, to the Roth TSP. And eventually they can convert all of it if they wanted to. But this is going to start, as I say, after January. Actually, the TSP has a starting date, starting anytime after January 28th, 2026. Traditional TSP participants will be allowed to convert portions of their traditional TSP to the Roth TSP. Minimum conversion amount will be $500. Of $500, you can make up to 26 conversions per year. Minimum $500. And your traditional TSP account includes contributions that you made as employee to the traditional TSP. If you're a FERS employee, and then all the earnings, FERS employees, matching contributions and accrued earnings, 1% of gross of SF50 salary, automatic contributions and accrued earnings can be converted. And if a TSP participant, traditional TSP participant, had rolled over money from traditional IRAs, from 401k plans, 403b plans they used to participate into their traditional TSP account, they also can be converted to the Roth TSP. This opens up a new opportunity. But again, it's not for everyone. It's not for everyone. And that's what I'm writing up in my column now. I just want to say this. I've gotten this question many times. It says, Ed, I love the Roth TSP. I put money into it, but boy, I sure would like to get a lot more. I would love to get a lot more money into that Roth TSP account. I'm limited how much I can contribute each year, but I really like to build up that Roth account. So it sounds great, especially now the Roth TSP, because the Roth TSP is not subject to R&D. So you could keep that Roth TSP account indefinitely, not have to take any money out of it. It's growing tax deferred. Pass it on to beneficiaries, also tax free. And I've gotten this complaint. Well, the only way I can build up my Roth IRAs then, because what I was planning is I was going to put money into the Roth TSP. I'll contribute to the Roth TSP. Eventually, I could roll it into the Roth IRA. But boy, I would love to get a piece of that traditional TSP into a Roth IRA. How can I get a piece of my traditional TSP into a Roth IRA? I said, you can, but you have to do it indirectly. You cannot do a direct rollover of your traditional TSP into a Roth IRA. You have to do a rollover of your traditional TSP to a traditional IRA, convert traditional IRA to a Roth IRA. Now you don't have to go through that. You have to go through it. You can do all your conversions within the TSP, while converting traditional TSP to Roth TSP.
Gotcha. And folks, stay tuned because Ed is crafting away on this, and we will be digging into it in January. So folks, as usual, Ed has some great details and important calculations and charts. So hit the Fed Zone and read the full article. There's plenty of good stuff in there. Brother Ed, once again, I don't know how you keep all this straight, but I want to thank you on behalf of all the feds and on behalf of us for doing it. No one else is putting this stuff out there. So it's a huge help for everybody there, and we're very grateful for that.
You're welcome. My pleasure.
Folks, that's a wrap. We are Serving Those Who Serve. Hit that subscribe button if you're on YouTube or Spotify. And please remember to share this with friends and strangers. Don't forget our live webinars every single week. Just head over to the website, swserve.com. Click the webinar button. You'll see the whole menu. The guru will come to you, reach you where you are, teach you where you are, and above all, serve you where you are. Sign up for one, sign up for all, share it with your friends. They will thank you. Be sure to read Ed every single week in the Fed Zone. That's fed-zone.com. And so, signing off for Ed, guru at Serving Those Who Serve, and me, Dan Sipe. Once again, I'll say it as I always do. Good luck, Godspeed, and please remember, it's your Fed life, so please make it a great one because you deserve it. Stay well, everybody. We are out.